creates a new India. So congratulations to PMS Bazaar. Hope you guys prosper in the years ahead. So on that vein, appropriate vein for us to discuss policy and their impact therein. I've got 15 minutes as the counter, so I'll move quite swiftly. What I'll try to show you is there's no great link between economic governance, political governance, and economic growth and the stock market. A lot of people try to link political reform, economic reform, GDP growth, earnings, stock market. It doesn't work. There is no such thing in the real world where you say this reform will lead to that GDP growth, which will lead to earnings over there and stock price movement. That happens in textbooks that you read in college. In the real world is more complicated. And I put that quote from Orson Welles up there. Orson Welles very nicely put it. He said that, look, if you look at medieval Europe, if you look at Renaissance Europe, the bourgeois in Florence, they were brutal murderers, right? They were basically mafia dons. So these guys ruled Florence basically like mafia dons. And under their patronage, under their rule, Michelangelo prospered, Leonardo da Vinci prospered, and the Renaissance arrived. In the meantime, in Switzerland at the same time, they had democracy, they had brotherhood, they had lots of love, I'm sure, but all they produced was the cuckoo clock. So anybody in our country who says, let's wait for stability, harmony, GDP growth, and that's when I'll invest, well, I think you might be waiting for a very long time to invest. What our history shows, what India's history shows, is the 2 years after general elections is where 80% of the Sensex's returns come. It's quite astonishing. In fact, in the 2 years after general elections, it's very, very difficult to lose money. That's what the historical data suggests. It's quite astonishing data. Even I had to look at it quite hard before I could understand it. Now, why does this happen is something we'll dwell on. Which companies benefit? Which companies benefit from that post-general election 2-year rally? Right? Why does this happen? Who benefits? That's what we'll try to dwell upon in the next 13 minutes or so. So here's the data, very simple data. You take Sensex returns, one year and 2 year CAGR after general elections. And what the data shows you is that barring the 99 elections, every single election since 1984, early 80s is when we started liberalizing our economy. So barring the 99 elections, in every single election, 2-year period after the elections, the Sensex has given positive returns, 99 being the only aberration. Even more strikingly, the average 2-year return post-general elections is 27%. That's CAGR. 27% CAGR is what you get in the 2-year period after general elections. Now, Sensex ka 35-year CAGR is 15%, right? You do the numbers, you see Sensex 35-year CAGR is 15%. What you realize then is 80% of the money that's been made in this Indian stock market has been made in the 2 years following general elections. It's absolutely freaky how powerful the general elections effect is. Now, why are general elections so effective? Before we go to that, just to get one holy cow out of the window, there is no correlation at all between GDP growth and stock market returns. There isn't any in India, there isn't any in the United States, isn't any in the UK. Nowhere in the world is there a correlation between economic growth and stock market returns. Yes, it's a subject that should be of interest. How fast is the country growing? But from a stock market perspective, economic growth ain't very relevant. It certainly shouldn't be the fulcrum of a discussion with our clients or your clients as to where are we going in terms of wealth generation, right? So why do general elections act as such a catalyst? It's a big topic. I don't claim to have any great answers. People have been thinking about this for the last 100 years. I would suggest John Maynard Keynes began the journey 100 years ago of trying to figure out how does political governance impact economic policy, impact the economy, and onto the stock market. What is clear though is in a democratic society like ours, in a democratic country like ours, the main lever that you and I have of impacting the country is via elections, right? In fact, I would argue the only lever, with all due respect to people who are very active on social media, the only lever you and I have of impacting the way the country is run is via the elections. And since elections are the mechanism by which the populace impacts policy, elections tend to lead to policy reform, right? If you see India's policy reform, with notable exceptions like GST, notable exceptions like GST, most of our policy reform has come in the 2-year period following general elections. The easiest example is 1991, right? May 91, the elections took place. I think 8 July or 8 June, July 1991, Manmohan Singh and P.V. Narasimha Rao opened up the country to the broader world, right? So election results typically are followed by economic reforms. Those economic reforms lead to the stock market starting to discount future gains. The economic reforms typically lead to an economic slowdown, right? Logical. If there was no slowdown associated with the reforms would have taken place a long time ago. Economic reform typically leads to a near-term economic slowdown. There's a cost associated with reform. If there was no cost associated with reform long time ago ho chuka hota, right? Reform, economic slowdown, even as the economy slows down, the market starts discounting future gains. No great science to it. It's happened several times before. The only thing is the power of this effect is such that when you see the numbers, it hits you. Right now, an example of this is what's taken place in the month of September, right? What happened in September? Two things happened. The FM cut the corporate tax rate by 10 percentage points. And further, she said that if you set up a new plant, I will give you a 15% tax rate on the new plant, right? Now, immediately people said, whoever has high tax rates benefits. That isn't true. If you have a high tax rate, but you don't have an ROCE engine, you don't have an economic engine which delivers return on capital well above your cost of capital, it doesn't matter what the tax rate is, you're a finished company anyway. Out of the Nifty 50, 35 companies haven't made a return on capital above their cost of capital even once in the last 10 years. It stands to reason those 35 companies don't actually benefit from the tax cut, right? You only benefit from the tax cut if your ROC is above your cost of capital. If you don't have ROC above the cost of capital, you don't have an economic engine, you might as well forget about it, right? So step one is, yes, you need high tax rate, but you also need high ROC so that you have a cash generation engine. Step three is, you need to see whether the company reinvests surplus cash. High ROC means you generate a lot of cash, but do you reinvest it? If you don't reinvest the cash, you don't benefit from the 15% tax rate, right? So if you follow this three-part mechanism, I've tried to list it, you need companies with high tax rates, high return on capital, high reinvestment ratio, right? I've used the slide from our recent newsletter to show you that we've invested in such companies, but I'm sure there are others in the room also who have companies, who invest in companies where the tax rate is high, where the ROCE is high, and the reinvestment of surplus free cash flows is high. These companies form barely 1% of our stock market. So in very simple terms, barely 1% of our stock market actually benefits from the momentous tax cut of September 2019. This is how economic reform works. Economic reform doesn't work in terms of dropping money from a helicopter so that everybody gets the money. That doesn't happen. You pass reforms which benefit a select few, those companies roar up, and the discounting of economic reform begins in the stock market. Now, I've tried to show this point more generally. I've used HDFC Bank and Asian Paints as examples to show you what happens to HDFC Banks and Asian Paints in the wake of, in the 2-year period of following general elections. There's a common misperception in our country that to benefit from reforms, you need to buy capex-oriented plays, you need to buy broken balance sheet companies, you need to buy what's euphemistically called high beta plays, right? That is rubbish. It does not work. Right? It does not work because the company has a broken balance sheet and poor corporate governance. It does not matter reform hota hai, nahi hota hai, that company ain't going to benefit in any which scenario. On the other hand, you take these two companies, and I've taken two respectable companies with good ROC engines and good corporate governance. Just look at what they do in the 2 years after general elections. So the Sensex CAGR in the 2-year period after general elections is 27%, right? Still astonishing me. 27% CAGR is what you get in the 2 years following general elections. HDFC Bank's CAGR in the 2 year following general elections is 52%, right? HDFC Bank hasn't ever given negative returns in the 2 years following general elections. Now, I don't know about you, you might be doing DCF, you might be using PE multiples, but if someone tells me that a company gives 52% CAGR in the years following general elections and it's never lost money after general elections and it's a well-run company, I think that's typically good enough to convince me that this is how I should go about investing. I shouldn't be running after high beta plays and broken balance sheet plays and companies whose order book will swell tomorrow morning as reforms are announced on or next week, right? So I've tried to lay this construct out. As you can understand, my reckoning is, and I'm sure there are many of you in the room who also agree with me, we are going to see more reform. It's relatively clear that the government has no choice. They will have to keep hitting the reform button every month or so, given the state of the economy. Logical reforms to expect after the tax cuts in September would be land reform. No point telling people I'll give you a 15% tax rate on setting up a new factory if I can't get you land to set up a new factory. So I would expect to see the land reforms come through, which is basically an amendment to the Land Acquisition Act, which was expedited in 2013. Right? We'd probably expect to see an amendment of that Land Acquisition Act of 2013 in the winter session of Parliament. Second area would be labor reform. Right? If I build the factory and I can't hire and fire people, it's also pointless. Now, will the government have the courage to take on labor reform? I don't know. My hunch is the state governments will be asked to take on the mantle of labor reform. But logical thing is you've announced the corporate tax rate cut, you then announce land reform, and then you do labor reform, right? In parallel, given the extent of the corporate tax cuts that have been given, not to do income tax in the budget would be anomalous. So logical expectation should be that we do get to see a degree of income tax cuts in the budget. And finally, you've seen the pattern of the announcements, right? Friday evening, press conference, big bang announcements. So logic suggests that something before Diwali, odds are that something before Diwali will also come through. The specifics apart, the message of history is clear. The message of history is that 80% of the returns from the Indian stock market come in the 2 years after general elections. I'm sure most of you are in this room. It's very good to see the room filled to the rafters, quite literally. There isn't a single inch of space in the room. I'm sure most of you are here to benefit from those rallies post-elections. I wish you the best of luck in your investments. Thank you. Thank you, Famous Bazaar.